We will start off the economic prognostication section with another great quote from Howard Marks, who said, "Everything you need to know in the years leading up to the crash could be discerned through awareness of what was going on in the present. This is because we generally do not suffer from a lack of information, but rather from too much information, and we often view that information through emotionally colored glasses. With hindsight, it often seems obvious that the relevant information was staring us in the face, but that we just didn't see it. So we're going to try and break things down into really simple concepts to help us understand what may happen in the future. Let's start by revisiting what we said at the end of the last presentation in February. At the time, the market had not turned, but uncertainty had increased, and the expectation was that rates would start to rise in the near future. We asked the question of whether Fed action would cause a recession in the near or more likely medium term. We said that it was possible home prices would soon peak, but that it was still possible for prices to keep rising in the very short term. Lastly, we said that in the medium term, prices would need to revert back to the mean, either through declining real estate prices or sideways price movements for a longer period of time. But that long term, we were still very bullish on real estate in the GTA and areas in southern Ontario where we lend. So this is always the most important slide that we show. It shows the price of the average single-family home in the GTA, which is the dark blue line on the top. You can see the dark gray, much smoother trend line, which represents a 7% growth rate. You can easily see that after growing by 63% over the last 2 years, the average single-family home price is more than 40% above this trend line. We've included the average prices for apartments and townhomes as well, which the trend line does not apply to, just to show you that this price movement has not been confined to single-family homes. Lastly, it should be noted that the market has started to turn, and you can see that in Q2, prices have started to move down. This was again the case for May, which is not captured on this graph. The same story has not been confined to the GTA either, with most markets, and certainly the secondary markets we follow, having the same unsustainable run-up for the last couple of years. These markets have started to turn as well. One thing to be mindful of going forward is that it is possible that the markets that saw the largest pandemic-induced increase in demand and prices could see bigger pullbacks in demand and prices going forward. Another representation of this turn in the market is in the sales to listings ratio, which essentially tracks the supply and demand levels for real estate. The orange bars represent the sales to listings ratio in 2022, compared to the last 3 years. You can see that after being firmly in the seller's market with a ratio well in excess of 60% in 2021, the ratio has declined to just under 50%, which is actually in the balanced market range, and alone would lead to expected sideways price movements. That being said, it is very possible the market continues to turn and that demand falls further or supply continues to increase, or both, which would eventually push us into a buyer's market. So let's look at some of these drivers for demand and supply, starting for the ones that are bullish for real estate. To start with, supply in the GTA continues to be constrained. The map on the left shows the greenbelt, which has turned the GTA into an artificial island, while the map on the right shows the outdated, single-family zoning of the yellow belt, which leads to an amazing 32% of the City of Toronto's landmass being zoned for single-family housing only, which does not even allow townhome development. Our outdated zoning laws and lengthy and costly approvals processes in part have led to a persistent decline in housing starts in the GTA. The gray line shows single-family housing starts, which are less than half of what they were 20 years ago, when the GTA was a city of 5 million instead of almost 7 million. Even when taking into account other types of housing, like condo units, housing starts have been about flat over the last 20 years, and completely insufficient to meet demand. Resale supply continues to be tight, although it has started to move more into balance, which is why it was light green in terms of our bullish indicators. During the previous year and the start of this year, all areas in the GTA had an amazing 1 month or less of inventory, compared to 4 to 6 months in a balanced market. You can see that at the end of April, inventory levels had doubled in most areas of the GTA, but were still fairly tight around 1.5 to 2 months. It is likely that inventory continues to rise before we see any major price corrections. In the medium and long term, immigration is projected to increase significantly in Ontario, as you can see by the bar chart on the left. And as you can see from the graphic on the right, most of that immigration will settle in the GTA and central southern Ontario, which are the areas we lend in. Household formation also plays an important role in the demand for housing. The chart on the right shows that over the next 25 years, the proportion of the population in Ontario made up by seniors will increase significantly. This demographic will be downsizing and putting negative pressure on housing prices. However, as you can see from the bar chart on the left, the bulk of immigrants coming over will be in the prime age range for family formation, which will be very important for housing demand and the productivity of our economy as a whole. Employment is largely back to where it was before the pandemic, with a lot of unemployment left being structural in nature, as numerous industries and companies are facing a shortage of employees. The GTA and Kitchener-Waterloo corridor also continues to create high-paid tech jobs faster than just about any other city in North America. So now let's look at the factors that are bearish for real estate, namely increasing interest rates, declining home buyer balance sheet strength, and the shrinking Fed and Bank of Canada balance sheets. Let's start with interest rates, which bottomed out in Canada in 2020 to historic lows. The light blue line shows the 2-year Government of Canada bond yield, while the gray line shows the 5-year yield. The dark blue line tracks the weekly effective household interest rate, which factors in the type of debt households hold, and the effective interest rates they are paying on that debt. You can see that rates have rebounded very quickly in 2022 and are back to essentially where they were pre-pandemic, but with the exception that they will continue to rise. This will be a major headwind for housing prices because new buyers will have significantly eroded buying power. However, it is important to point out that, at least in the short term, we are unlikely to see a rash of forced sales from increased mortgage defaults, from homeowners who have to renew at much higher interest rates. This is because borrowers are currently renewing mortgages from 5 years ago, when interest rates were similar to where they are today. In 2025, when the first pandemic-era mortgages come up for renewal, this will be a different story. However, I think this is actually one of the reasons why we will not be able to keep interest rates as high for as long as some think. Household debt levels are also at an all-time high. After declining in 2020 and 2021 due to government stimulus, household debt has now exploded to 180% household income. This will make rising interest rates really bite and could be a recipe for a recession. The interest rate that the Bank of Canada sets is only one tool they have to control market liquidity, and certainly only tells a part of the story of the past 2 years and what is to come. The arguably more important part of the equation has been the expansion of the Fed and Bank of Canada balance sheets, also known as quantitative easing. This is when central banks print money to buy assets like bonds from the market. This both increases the liquid cash the market participants have on hand and increases demand for bonds, which in turn increases the price of those bonds and decreases their yield. So, more people are able to borrow, and there's more money in the system to be spent, so economic activity is stimulated, and the price of most assets, like real estate, increases. The opposite of this eventually has to occur, which is called quantitative tightening. Here, the central bank sells assets it had formerly purchased. This has the opposite effect by decreasing the supply of money that market participants have and decreasing the demand and price of bonds, which raises interest rates, removes liquidity from the system, and causes the economy to slow and asset prices to fall. and this has already begun. This graph shows the Bank of Canada balance sheet, including total assets, which is the blue line. The largest asset class they hold are their own Government of Canada bonds that they previously bought back, which is the gray line. But in the latest QE, they purchased corporate bonds and even equities as well. You can see the spending spree the Bank of Canada embarked on in 2020, especially when you contrast it to the very mild response in Canada to the 2007 financial crisis at the start of the data series. It's basically dwarfed by the scale. The balance sheet has started to taper, and as this continues, it will be akin to additional and less publicized interest rate increases. The Wu-Xia shadow rate attempts to incorporate the effects of quantitative easing on the effective market interest rate. While this chart is for the US and we don't have a shadow rate published in Canada, the same concept applies that we have essentially been living in a negative interest rate environment for the last 2 years, which has led to the abundant liquidity that caused asset prices to appreciate so greatly, and this will not be the case going forward. I want to leave you with one more thought about real estate bubbles. Famed economist Paul Krugman once explained that real estate prices tend to be pretty sticky on the way down, and because of this, real estate bubbles usually go out with a hiss instead of a pop. In other words, once we have it in our heads that our house, our most valuable asset, is worth a certain amount, it takes time for us to adjust our expectations downward. And absent being forced to sell, we are more likely to sit on the asset for longer than with other assets that we are less emotionally attached to. We can see this on the chart that shows 2 previous real estate bubbles in Toronto. The data only goes to 2016, and the trend line is different from our analysis. I just want you to focus on the blue and red arrows, which show the 2-year price run-up from 72 to 74, which was followed by an 11-year unwinding of prices between 74 and 85. There was then an even larger 4-year run-up from 85 to 89, which was followed by a more sharp 7-year decline. Real estate bubbles can unwind quickly or over more than a decade, but there's generally no Black Monday where prices are down 50% in one day. So looking forward, in the short term, it is likely that interest rates continue to increase, which has the possibility of pushing us into a recession. We believe prices have peaked, and the question now is how fast they move down and for how long. It is possible that lack of supply and other fundamentals we talked about help prop up prices to some extent in certain markets, but it is possible inventory levels continue to increase, especially if there is a wave of forced sellers. With very high levels of debt, interest rate increases in QT will really bite, and we believe interest rates will have to come down and/or a recession is likely to occur in the medium term. If prices don't move down sharply in the short term, it is probable that prices move sideways for a prolonged period of time, and possibly even for a decade. Of course, we are also always cognizant of the black swan event, or that thing you just didn't see coming, kind of like a global pandemic or war in Ukraine. In the long run, we remain very bullish on real estate in the GTA and Southern Ontario, and we believe, like the graph that showed those previous Toronto real estate bubbles, that in the long term, prices will continue to appreciate in this world-class city.